Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, going to go through a 2025 outlook by Goldman Sachs done by their global equity strategy team. So lots to touch on in terms of global markets, stocks in particular. That's the main focus of this report. And I thought it'd be worthwhile doing a bit of a deep dive. We'll get into the PDF version, break it all down for you so you get an idea on their thoughts. Global stocks for 2025 by Goldman Sachs. Okay, let's get into the report. Okay, so on my screen we have the report in front of us, and this is done by the global equity strategy team at Goldman Sachs. They did this in November, just kind of mid-November, and put this out for 2025. It is their 2025 outlook. So let's get into it. We've got a summary on the first page, some really good bullet points here. I've made some highlights, save you the time of reading this stuff. I've done it for you. So we'll just go through and touch on the highlights that I've made and anything else that's relevant really. So a couple of things to start off with. So first thing, global equities have already risen 40% since October 2023, leaving them more vulnerable to any disappointments. I could not agree more. And that's definitely been the case. Equities have run up so much that any kind of disappointing news, bad news that comes out of earnings releases, for example, talk on interest rates like we've seen recently, maybe not coming down as much in 2025, could lead to more disappointments in the equity markets for the next year. Okay, equity valuations have increased and leave little room for further valuation expansion. We expect index returns to be driven largely by earnings growth. So all they're saying here is they don't expect the markets to go up on the back of higher valuations being applied. They think valuations are rich enough. They expect the markets would only go up if companies report higher earnings growth. And we'll find out. We'll find out in January for the end of 2024 what earnings were like from companies. They forecast total equity returns in the US dollars of 10% through the end of 2025. To be fair, 10% is almost right along the long run average of the S&P 500, and it's actually quite a good return. So considering we had 2 years of 20% plus back to back, I think if we were to get a 10% return in 2025, I think that would be a fantastic result. So let's hope that that's the case. Okay, we focus on diversification to improve risk-adjusted returns. Probably means getting away a little bit from the Mag 7, but we'll find out as we get into the report. And what else do we have here? They highlight 4 key themes: market broadening opportunities, selective value, geographical diversification, and enhanced capital market activity. By that, well, they really just mean more mergers and acquisitions. Okay, so let's have a look. Exhibit 1 illustrates the rise in the S&P 500 in 2024 has been the strongest since 1928. That is incredible. What a fantastic year 2024 was, and we're very lucky to have had that sort of returns. The current equity upswing began in October 2023. You may remember there was a lot of doom and gloom back in October 23, and then the market turned around and started to move up, driven by optimism in peak inflation and the prospect of a Fed pivot, because that is when the Fed started to talk about pivoting towards reducing interest rates. Have a look at this chart in Exhibit 1. You're looking at the sort of orange color line here, 2024 for the S&P 500. And with that returns that we saw in 2024, it's putting it in the top decile. And that is the strongest since 1928. So we've had a fantastic year, but we kind of know that, okay? Around half of the equity return globally in 2024 has come from valuation expansion, driven by growing optimism and lower inflation and interest rates. So there you go. So the explanation for the big run up that we've had in 2024 was more due to expanding multiples, not so much on increased earnings per share by companies. Just that people are willing to pay more for their earnings because interest rates were due to come down. As interest rates come down, multiples, stock prices tend to go up, all else being equal. Okay, and that's because the value of their future earnings in the future, when you discount those earnings back in today's money, you do so at a lower discount rate than you would do if interest rates were higher. So that's a big part of it. Valuation expansion, the reason for the run up in 2024. Exhibit 2, half the equity Return globally has come from valuation expansion, as we just discussed. As you can see here for the S&P 500, it's just broken it down in a bit of a graph. So we got dividend contribution is that little gray bit. And then for this light blue color, this is earnings per share contribution and how much that contributed to the rise in 2024. And then look at this dark blue here. That is from forward PE. In other words, multiples, valuations expanding. Big part of the around 25% return we've seen in so far in the S&P 500 for 2024. Even the weaker economies facing greater structural headwinds like Europe and China have seen their stock markets enjoying a sharp re-rating since the fourth quarter of 2023, leaving them broadly in line with long-run averages. They're no longer cheap. So, headlines have not been great out of Europe and China, but their markets have done okay. Look at Germany. It's been trading around all-time highs despite a fairly weak economy there. Breaking it down again, same sort of thing in Exhibit 3. All regions have experienced a rise in valuations through 2024. That's fine. As we can see here in the chart, it just shows the multiple expansions here, forward PE. Look at the S&P 500 in the US, around 22.7. So it is more or less at the top end in terms of valuations, okay? And if you look at the market trough in fourth quarter 2023, the multiple on the US stock market at the time was 17. So there you go. Multiples have extended up to 22 from 17 in the US. And where does that put us in terms of Exhibit 4 here? The stretch valuation in the US equity market is reflected across most standard valuation metrics. So here in these metrics, these are all valuation metrics, okay? This is how someone would determine whether a stock or a market is expensive or not. And when you look at all of these, like enterprise value to sales, cash flow yield, price to book, all of them forward PE, as we just discussed, the median absolute metric of those, right? When you look at their historic percentiles, EV to sales in the 100th percentile, okay? The median absolute metric is 97%. All that's saying is that the current valuation in the market is at the 97th percentile. Very richly valued indeed. Okay. We kind of know that. We'll keep going down. Let's find some more highlights on the report. Exhibit 6, the outperformance of cyclical versus defensive sectors in most regions in recent months, and particularly so in the US, suggests greater confidence in the trajectory of further growth. Pretty obvious. Cyclical businesses that do well when the economy is growing and is growing well, it's hot, let's say, they've outperformed, defensive things like utilities, consumer staples, things like that. So cyclicals have continued to outperform defensives. We've seen that for a long time as well, okay? For much of 2023 and 2024, this growth confidence was particularly elevated in the dominant of tech stocks. Nothing new there. We know that tech stocks have been dominating in terms of growth, sales growth, profit margins in some of these companies like Nvidia and Tesla, for example. So we know that. So for Goldman Sachs, their economists remain confident about the continued growth throughout 2025 for the US. They forecast 2.5% real GDP growth in 2025 compared with the consensus of 1.9. So Goldman Sachs for 2025 in terms of GDP growth in the US are actually a bit more bullish than the consensus. So that's good to see. 2.5% is a pretty good growth rate indeed. But they're below the consensus in Europe, 0.8% compared with 1.2. Look at the difference in the growth rates, GDP, between Europe and the US, 2.5 versus 0.8. So there's a difference there, and that is the reason that the US stock market has tended to outperform and valuations are higher. Okay, and relatively low recession probabilities, particularly in the US. That's good news because almost all the time there's economists forecasting recessions and they don't always happen. In fact, they mostly don't happen compared to forecasts. But that's good. Does not appear that there's a recession on site according to Goldman Sachs. Okay. Exhibit 8, strong past returns does not imply poor subsequent performance. Okay, so that's good news. The 1 year forward S&P 500 returns following a 1 year trailing returns history since 1928. So given that we had greater than 20% in 2024, The median return in the following year, the following 12 months, is 13%. So if it were to follow the median, then we could see as much as 13% return next year. Nevertheless, the fact that we've had a 20% year this year in 2024 could be bullish for 2025. Interesting. Remember though, 2023 was a great year as well, up 20%. So back-to-back 20% plus years. Will that turn into a positive year in 2025? Let's see. But Goldman is saying something positive about that. Okay. When you factor in the Case-Shiller PE, which is really cyclically adjusted PE ratios, kind of looking over a 10-year period to factor in different cycles or the economic cycle, it's maybe not as bullish. So given where we are right now on the Shiller PE, the median return would be at at minus 1%. So this one is not as bullish. We may see a minus 1% for 2025 based on the Shiller PE and his history. Okay. Periods of high valuation and earnings downgrades are typically associated with relatively flat market returns. Okay. So if we've got a period of high valuation like we do now, and then we come out with some earnings downgrades, and in January we're going to be seeing a lot of company earnings in the US reporting for the fourth quarter of 2024. That could lead to a fairly flat market for 2025. I made a little note here. US earnings season begins in January. So I'm going to be really watching this US earnings season in January because I think it's going to set it up really nicely for the year. If we don't think that valuations can expand much, then the market's going to have to be driven by earnings growth. And if we get the earnings growth, we can be relatively confident that we have a good year in 2025. But if companies are reporting in January slower earnings growth in Q4, and most importantly, their forecast for Q1, Q2 of 2025, if they're suggesting earnings won't be as good as hoped, then that to me is a pretty good indicator that 2025 may be weaker than this report suggests. So keep an eye out for earnings season in January. For me, I think it's going to be pretty key this year because there's not much room for valuations. Earnings per share will have to drive the market in 2025. Okay. So if we look at Exhibit 10, when global equities have a high valuation, currently around 18 times, the next 12-month returns are generally only good if earnings revisions are positive. So like I said, where we're at right now in the markets, we will need to see earnings per share growth and good forecasts, upgrades in order for us to have a good year this year. And this is what the returns can be. So if we're greater than 16 times and we have upgrades in earnings, the next 12 months, we could actually see a 10% return in the equity markets, which would be kind of along with Goldman is sort of predicted for 2025. So that would certainly be good to see. Let's watch in January. Okay. Exhibit 12, key market forecasts. Here we go. As of November 14th. So remember, I'm filming this kind of end of December. So this is, around about 6 weeks ago. But still, at that time, the S&P was trading at 59.49 and their index level going out 12 months. So the end of the year in 2025 is 6,500, which would give a price return of 9%. That's just the difference in the two index levels. You factor in the dividends and you're looking at a total return of around 11% for 2025. That would be very good indeed. If you look at some of the other major markets, so the stocks Europe 600 forecasting an 8% total return, Topics South Korea 17%, interesting, and MSCI Asia Pacific excluding Japan in dollars at 12%. So those are other markets you could look at if you wanted to diversify a little bit as well and potential returns. Hate to say it, but once again, Europe at the stock 600 coming in lower in terms of total return. And a lot of that's down to earnings and growth. Okay. Exhibit 13, our expectation is that most regions' earnings will become the key driver of index returns over the course of 2025. That's what I just said. And that's reflected in the graph here with this light blue color. So they expect earnings per share contribution to be the biggest driver of this 11% return. Let's hope that's the case. Navigating the risks. Okay. There are two risks in particular that investors face as we approach 2025, according to Goldman Sachs in this report. The first is that the recent wave of optimism has front-loaded returns, leaving them vulnerable to a correction. I actually personally believe this to be the case. We've had such a good run since the end of the election period there in the beginning of November. I feel a lot of these returns have been front-loaded. The optimism is all priced in. The expectations have been so positive around this changing government and some of these policies for the most part that a lot of this may be priced in already to the S&P and the US stock market. So if there's anything, whether that's, an inability for the Trump administration to deliver on some of their pro-growth policies, for example, or companies report negative outlooks when they report in January, then we could see a sell-off and a correction, which in my opinion is probably pretty healthy. Wouldn't be surprised if we see 5 or 10% down in Q1 for me. But look, it's impossible to know for sure. It's just something that I feel based on this. There's many unknown risks around tariffs, for example, and the impact on global growth and inflation. We expect modest decline in bond yields in 2025. Any further rise in bond yields driven by fiscal pressures would likely tip the balance. Okay, so what does that mean? Well, okay, interest rates, bond yields, they have a huge impact, probably the biggest impact on stock prices. We've seen kind of US 10-year yield tick up a little bit. It's up around 4.6% now. If that continues to go up because of inflation prints, because tariffs, let's say, have an impact inflation, I don't know whether they will or not. I don't think anybody truly does. But if we start to see some of that, then we're going to expect less interest rate cuts in 2025. Back in September, the market was pricing in 4 cuts for 2025. It's now pricing in 2 only since Fed Chair Jay Powell recently spoke. If interest rates do not come down as much in 2025, you can expect stock prices therefore to reflect that and probably sell off a little bit. Okay, the second risk relates to the unusual degree of market concentration. I did a video on this recently, another Goldman Sachs report where they forecast 10-year returns to be only 3% a year after 2025, okay? And the main reason for this was market concentration. You see, when the big companies, Microsoft, Apple, Amazon, the Magnificent Seven as they're called, they've become such a big part of the S&P, their market caps have grown so much. This concentration we've not seen in 100 years. And according to Goldman Sachs, that is a very bearish signal because these companies should not be able to maintain the levels of profit margin and profit growth that we've seen. So for them, for Goldman Sachs that is, concentration in the stock market is a big warning flag and a big risk to the market. Is it? It's difficult to say. These companies are so heavily concentrated because they make so much money. It's as simple as that. And because they've executed so well, so much money going into technology. But when you look at this chart in Exhibit 16, the biggest US companies have outperformed the index for good reason. They've generated much stronger profit growth. Look at those earnings per share, this blue line of the Magnificent Seven versus the S&P 500. Unbelievable outperformance versus the rest of the S&P 500, the 493 companies left. So that's why the concentration is so high. And that's maybe not as bad a thing as Goldman would have us believe. Okay. There are risks when the markets become highly concentrated. One risk is reflected in the shift in mega cap technology from being relatively capital light to capital intensive. The prospective return on this capital invested is likely to fade. Historically, it's been difficult for any firm to maintain high sales growth and profit margins over sustained periods of time. Okay, good point. This comes back to AI spending and investment for me. These companies are investing an awful lot in AI and the infrastructure and rolling everything out. And they're going to need to see a return on that, return on their invested capital and their capital expenditures here in order to maintain these profit margins and profit growth. We need to see some of that stuff coming, or at least some better clarity on when they're likely to expect some returns from their AI spending. Okay, I think that's going to be a big key as 2025 rolls on. So what can you do? Well, you can diversify a little bit. We've heard this many times. Every year at the end of the year, we hear US is overvalued, at risk of a sell-off. Maybe look at diversifying your portfolio. We continue to focus on diversification and alpha generation. Alpha generation, okay, just generating a return that beats the actual market. That ultimately is the name of the game, okay? Broader participations, that's fine. The reality for portfolio managers, it's been particularly difficult to outperform mega cap. Indeed it has, and that's because their profit growth and their earnings growth has been so strong, as we just saw. While these companies, being the Mag 7, remain attractive, we believe that investors should broaden their investment universe more than they have been used to in recent years. In all honesty, we've heard this every single year. It's time to broaden out from the Mag 7, and look what they do. They continue to deliver. But what do you think? Perhaps you think it's time to move a little bit out of this and go into some other areas of the market, maybe small caps or other sectors that haven't had as good a growth. Okay. So we'll keep coming down, and let's see, selective value opportunities. Here we are. So while we like broadening exposure to growth, we also like the barbell approach, which includes selected areas of value. So this would just suggest moving some out of the Magnificent Seven, the big tech companies, and moving it into areas that are got better value. Okay, that's parts of the market where they just don't have the valuations that technology does, or it could also mean parts of geographical markets, places like the UK, where valuations have been extremely low and continue to be low, but they have been low for some time. And that's the risk you take. If you move out of the US and you put some money to the UK or Europe, Japan, for example, maybe even China, if you're up for that, then you take a risk that you could miss out on future returns in the US. Here they go. Geographical diversification. To be clear, we are confident about the US economy and we like the US equity market. Well, okay, that's good. That's good to know that they're clarifying that. That said, the degree of outperformance and valuation premium leaves selective opportunities for geographical diversification. And yes, indeed, the UK and China have been named here as places with lower price to earnings growth ratios. So you could look to rebalance a little bit and reallocate some money to markets like Europe, UK in particular for valuation, and maybe even China. Capital markets activity. Okay, given the likely push towards deregulation in the US and stronger forecast growth, we expect increased capital markets. So Trump has come in, he wants to have a lot less regulation, so he wants a deregulation to move forward. And if that happens, companies are going to start buying out other companies. And that could be an area for you to put some money. The trick about that is you have to identify which companies are likely to be bought out. And that's very difficult to do. But if you could do that, you could enhance your returns or your alpha in 2025. Finding targets of potential mergers and acquisitions activity. A lot of people are expecting higher mergers and acquisitions activity in 2025. Okay, so that's the report. And basically, really what Goldman is saying here is a little bit positive, I think, compared to that other report that I did the deep dive in. Link in the description for that one. And forecasting 11% return for the US stock market for 2025. A bit more bullish than I had expected. But I think the main takeaway from all of this is the market is richly valued, and any returns, positive returns in 2025 will need to come from an increase in earnings per share. Companies will need to earn more money than they did in 2024. So watch the January earnings season in the US. It's going to be a blockbuster one in my opinion. Particularly the big names, Apple, Nvidia, all of them. Get an idea onto what their fourth quarter was like, and most importantly, their forward guidance for Q1 and Q2 of 2025. And I think that will give us a really good indication of what the market's likely to do. Of course, anything can happen. When it comes to stocks in the stock market, anything is a possibility. We never really know what will happen going 1 year out, but these are things we can think about and look for in 2025. So that's my video on the Goldman Sachs 2025 equity outlook. And let me know your thoughts. Leave me a comment. Tell me what you think about the markets in 2025, where you think it's going. And if you like the video, share it with a friend. Subscribe to my channel if you haven't done so already. I could really use the support. Keeps me doing videos like this. I love to produce this stuff for people like you. Hopefully it saves you some time in reading this stuff and the reports. Thank you so much. Wish you all the best in 2025 in your saving and investing and everything in your life. And we'll see you in the next video.